Hello, welcome to LCG's preview for the week ahead. I'm going to discuss the Lunar New Year, 8-month highs for gold, the Bank of England rate decision, and Trump's State of the Union address. Before that, I'll run down the biggest events in the economic calendar. So this week, markets in China as well as other parts of Asia are closed for Lunar New Year. But in terms of economic data, on Monday, there is a US trade balance. On Tuesday, the RBA interest rate decision, European services and manufacturing PMIs, as well as the ISM non-manufacturing PMI out of the US. On Wednesday, it's President Trump's State of the Union address. On Thursday, it's the Reserve Bank of India meeting, then the Bank of England rate decision, as well as quarterly inflation reports. Then on Friday, it's UK GDP. Moving on to the top corporate results to watch this week. Ryanair, Deutsche Bank, Google parent Alphabet report fourth quarter earnings on Monday. Ocado and BP announce full-year results before Walt Disney and Snap report Q4 numbers on Tuesday. Daimler, BNP Paribas, Carlsberg, Nestle and GSK all report full-year earnings before Barrett Developments gives a half-year update, and General Motors reports Q4 earnings on Wednesday. Total SA has full-year results. Thomas Cook and IAG give their half-year earnings reports, while Fiat Chrysler, Spotify, Twitter all report Q4 results on Thursday. And then finally, Air France and SSE report half-year earnings on Friday. So I wanted to speak just briefly about the Lunar New Year. The typical effect here, although it's not actually necessarily taken place this year, is for there to be a bit of a sell-off in Chinese markets in the lead up. That's just on withdrawals of investors from the domestic market so they can fund their New Year activities. Makes sense. The net effect there is that you'd expect quieter trading in the rest of Asia, so that Asian sessions should be a little bit thinner trading than normal. Not necessarily any wider effects outside of China, just except that the PBOC would typically ease policy, which they have already done leading up to it. And obviously in the greater scheme of things, China has been at the center of attention this year in terms of the global growth story. So to some extent, we get a break from China's influence on global growth, and especially with the more dovish Fed meeting last week, we can probably put global growth combined with monetary policy concerns behind us to some extent. And so on that front, definitely a beneficiary of that dovish Fed is gold. It's had a big winning streak here. The Fed is the main reason for this. The US dollar has been sliding, not necessarily as a basket, but definitely against a few key currencies. And while some other currencies remain a bit uncertain, particularly the British pound, re Brexit, gold has actually been one of the go-to places that market participants have looked to sell dollars, i.e. buy gold based in dollars. Hard to make the case that there are haven flows going into gold at the moment because equity markets have been rising. Although you could make the case that maybe equity markets need to catch up gold via a correction lower, or gold needs to catch up to equities via a drop, because there has been a bit of unusual divergence between the two, i.e. both moving higher together of late. But I think it's probably fair to say more broadly that even if the Fed has averted it for now, the US and perhaps more globally, we are getting closer to a recession, closer to a larger correction in markets if we're not there yet. And so it makes sense to hold gold in your portfolio for that reason, just purely for the protection purposes. Low inflation though, so hard to see very long-term potential for gold, but nonetheless it seems to be performing very well so far this year. We have to see how well that will maintain itself. The Bank of England, well, we've said for the last few times now, and nothing really changing this time, is that the Bank of England are on hold because of Brexit. But we obviously are approaching that March 29th deadline. There's only so many more meetings where we can use Brexit as an excuse, or at least the Bank of England can, for not doing anything. And one big difference this time around is that UK wages are on the rise. Also, last time around, we had record high unemployment, specifically with wages, real wages, hit the highest since that EU referendum. So consumers got more money in their pocket. Naturally, that should feed through to a stronger economy. And notable that the UK economy now outperforming the likes of Germany and France and Italy, which just fell into a recession, into a technical recession with 2 quarterly declines in GDP growth. So fair to say that the UK, as we've been saying for a long time now, certainly not in need of the low rates that it has. But more specifically with this meeting, we don't really expect Mark Carney to raise any major prospects of a rate rise while we've got Brexit on the table. What he could do is allude to the stronger wage data, and if he were to do that, that probably should be a positive for the pound. He may warn on Brexit, but I think to some extent what the market's doing at the moment with regard to the pound is that you really don't know on Brexit. But one thing you can see is that wages and the UK economy more broadly suggest a rate rise. So markets moving more in line with the economic policy and kind of putting Brexit to one side, perhaps assuming the best case scenario. Trump also making his State of the Union address. So US markets have been rising despite the government shutdown. So I don't think politics playing such a large part because the Powell put is in place, i.e. meaning that the Fed is there to back up the markets. The Fed just 6 weeks ago was talking about raising rates almost automatically, drawing down their balance sheet on autopilot. That's all changed just after the markets pulled back 20%. So with all that being said, stocks are still doing well, but in any normal circumstances, ideally you would want a more functional government. Trump has been banging heads with Nancy Pelosi. And so the question being, in his speech, what kind of tone does Trump set? He could go for the more populist, combative tone, or a more conciliatory tone, which would suggest he could work better with the Democrats. Given the spat with Pelosi, my bets would probably be on the more combative side, but the main point being that doesn't necessarily have to roll markets, given the current conditions that we're in. So thank you very much for watching. Good luck with trading this week. And if you want to see these videos as soon as they are released, please follow LCG on YouTube and social media.